Europe in the late 18th century was a continent of kings, wars, and endless ambition. Monarchs needed money to fund armies and build empires, but taxes alone weren't enough. Into this world stepped one family from Frankfurt, Germany, whose name would become synonymous with banking, the Rothschilds. Meyer Amschel Rothschild entered the world in the year 1744, born into a Jewish family residing in Frankfurt. His upbringing was marked by the challenges that many Jewish families faced during this time, including stringent restrictions on property ownership and limited access to various professions. Despite these obstacles, Meyer displayed an early aptitude for numbers and trade, skills that would later serve him well in navigating the complex financial landscape of his day. He was adept at forging relationships and building trust with those around him, a talent that would become crucial in his pursuit of success. However, it is essential to recognize that while Meyer's abilities allowed him to carve out a niche in finance, his rise was not solely a product of personal merit. It was also facilitated by the socio-economic conditions of the time, which he skillfully maneuvered to his advantage. Thus, his journey reflects a blend of personal talent and the opportunistic exploitation of the circumstances he encountered, rather than an unblemished narrative of virtue or greatness. He started by providing banking services for local merchants, offering them loans and facilitating trade transactions, which were critical for their business operations. His reputation for reliability and integrity quickly spread throughout the region, leading to an increase in clientele. As his influence grew, he gradually became the court factor for the Landgrave of Hesse-Kassel, a German prince who needed funds to support mercenary armies during various conflicts. This role not only elevated his status, but also allowed him to engage in larger financial dealings, such as managing the prince's treasury and overseeing the logistics of military financing. The intricate relationship between banking and warfare at this time underscored the importance of financial institutions in shaping political landscapes. As he navigated the complexities of royal finance, he began to implement innovative practices, such as the issuance of promissory notes, which would later become a cornerstone of modern banking. His ability to adapt to the needs of both merchants and nobility laid the groundwork for the evolution of banking services, paving the way for more sophisticated financial systems in the future. Meyer's greatest innovation was not merely the act of lending money, it was the strategic construction of an expansive and interconnected network. To solidify this vision, he sent his 5 sons to major European capitals: London, Paris, Vienna, Naples, and Frankfurt. Each son was tasked with establishing a hub for Rothschild operations in their respective cities, creating a web of influence and financial acumen that spanned the continent. This unprecedented approach allowed for the rapid flow of capital across borders, facilitating trade and investment in ways that had never been seen before. By leveraging the unique economic conditions and opportunities in each city, the Rothschild family could respond swiftly to market demands, ensuring their dominance in the financial landscape of Europe. This network not only enhanced their lending capabilities, but also fostered relationships with local elites, further solidifying their position as the go-to financiers of the age. This international network allowed the Rothschilds to transmit information and funds quicker than governments themselves could. They could finance armies, governments, and trade deals across Europe, all while managing risk through diversification and coordination. In a world without telegraphs or modern banking systems, the Rothschilds effectively created one of the earliest global financial networks. The Rothschilds were not just organizers, they were bold risk-takers. During the Napoleonic Wars, they used their network to anticipate troop movements and political changes. By moving gold, buying bonds, and negotiating with multiple governments, they helped fund the British war effort against Napoleon. While the introduction of financial instruments like bonds, letters of credit, and early forms of insurance undoubtedly allowed for calculated risks and wealth protection, these innovations also came with significant drawbacks. The complexity of these instruments often led to misunderstandings and misuse, creating a breeding ground for speculation and financial instability. For instance, the reliance on bonds could encourage excessive borrowing, leading to unsustainable debt levels that jeopardize not only individual investors but also entire economies. Additionally, the letters of credit, while facilitating trade, could also enable fraudulent activities, as unscrupulous individuals exploited loopholes to deceive lenders and investors. The early insurance models, meant to provide security, sometimes fostered a false sense of safety, prompting reckless behavior and moral hazard, where individuals took greater risks than they otherwise would have, knowing they were insured. Thus, while these financial innovations represented progress, they also introduced new layers of risk and uncertainty that could undermine the very stability they aimed to create. This combination of network, innovation, and risk-taking became their trademark, turning them from a local banking family into a continental powerhouse. The Rothschilds didn't just accumulate wealth, they reshaped how governments and businesses handled finance. Their innovations influenced government finance, international trade, and banking practices. Governments could borrow large sums more efficiently. Trade became faster and safer. Letters of credit and bonds became standard tools. While advisors to governments played a pivotal role in financing and stabilizing economies during tumultuous times, their influence was not without significant drawbacks. The concentration of power in the hands of a few advisors often led to decisions that favored elite interests over the needs of the general populace. Major infrastructure projects, while beneficial in theory, frequently resulted in the displacement of communities and environmental degradation. Additionally, the reliance on these advisors created a system where governments became overly dependent on external financial support, undermining their sovereignty and ability to make independent decisions. This dependency could lead to a cycle of debt and economic vulnerability, as nations found themselves beholden to the very advisors who were supposed to guide them towards stability. Furthermore, the advisors, driven by profit motives, sometimes prioritized short-term gains over sustainable development, exacerbating social inequalities and fostering resentment among those left behind. Thus, while their contributions were significant, the darker implications of their influence reveal a complex legacy that warrants careful scrutiny. The Rothschilds' strategy was also rooted in family unity. Decisions were coordinated across countries, with each branch reporting back to Frankfurt. This allowed them to reduce risk and leverage information faster than rivals. While their relentless pursuit of innovation brought about significant advancements in railways, mining, and industrial projects, it also came with a host of negative consequences. The rapid expansion often led to environmental degradation, as natural landscapes were altered or destroyed in the name of progress. Communities that thrived on traditional livelihoods found themselves displaced, their cultures and ways of life overshadowed by the relentless march of industrialization. Additionally, the focus on predicting market trends sometimes fostered an atmosphere of cutthroat competition where ethical considerations were sacrificed for profit. Workers faced grueling conditions in mines and factories as the drive for efficiency overshadowed their well-being. Ultimately, while their innovations positioned them as leaders in the market, the societal and environmental costs raised critical questions about the true price of progress. Their legacy is not just wealth, it's modern banking itself, international networks, risk management, and strategic investments. Many principles they developed are still in use today. While the lessons from the Rothschilds offer valuable insights into wealth creation and innovation, it is crucial to acknowledge the negative aspects that accompany such strategies. The relentless pursuit of opportunity can lead to ethical dilemmas where profit is prioritized over social responsibility. The calculated risks that yield significant rewards can also result in catastrophic losses, especially when the stakes are high and the market is volatile. Furthermore, the emphasis on building networks may foster exclusivity, creating barriers for those outside elite circles and perpetuating inequality. Family coordination, while beneficial, can also lead to nepotism and internal conflict, undermining the very foundations of collaboration and innovation. Lastly, the intelligence that drives transformative change can sometimes morph into arrogance, blinding individuals to the consequences of their actions. In essence, while the Rothschilds exemplify success, their journey also serves as a cautionary tale about the potential pitfalls of ambition unchecked by ethical considerations. The story of the Rothschilds is not just about wealth, it's about vision, strategy, and reshaping how money moved across Europe. From a small counting table in Frankfurt to financing entire nations, they changed the course of banking forever. In today's modern world, the concentration of financial power in the hands of a few families poses significant dangers that can ripple through society and governance. When a single family or a small group holds substantial wealth, they can exert disproportionate influence over political decisions, often prioritizing their interests over the common good. This can lead to policies that favor corporate interests, tax breaks for the wealthy, and deregulation that undermines public welfare. Moreover, the potential for corruption increases as these families may engage in lobbying or even bribery to secure favorable outcomes. As a result, the democratic process can become skewed, with the voices of ordinary citizens drowned out by the financial clout of the elite. This not only erodes public trust in government institutions, but can also lead to social unrest as disparities in wealth and power become more pronounced. The consequences extend beyond politics. When financial power dictates social norms, it can perpetuate inequality, limit access to essential services, and stifle innovation. In essence, the unchecked financial dominance of a few families can threaten the very fabric of democracy, creating a world where wealth translates to power and the ideals of equity and justice are sidelined. Thanks for watching. If you enjoyed this dive into history and finance, hit like and subscribe for more fascinating stories from the past.